Okay, let's see.
Yep, I think it's on. Oh no.
Do you know what they did this time?
No, I was in the back.
Apologize. This is the same problem we had previously, so they already switched out the laptop once. I mean, sir.
All right, so while we're waiting, I'll tell you a little bit about my personal journey and how I got interested in this stuff. So I was fortunate and unfortunate enough to actually be placed as the on-site director in place 3 years out of residency, because essentially they had interviewed about 22 people for an open chair position in a place that was so horribly broken that nobody they wanted to take the job, and they didn't like anyone else. So they left it open and it stayed open and open and open. And eventually I got placed as on-site director in a place I wanted to be chairman of a couple of years later. So my personal experience as to why I became interested in this was my very first experience with anyone in the C-suite. I had become convinced that the hospital could save a bunch of money by adding one internal ambulance, because they were paying an exorbitant amount of money to actually get people out between facilities on staff. So I went to the chief operating officer, who was remarkably nice and very supportive of me in that new role and the fact that I was way over my head. And he listened to me for about 15 minutes and he said, "Raheem, that sounds like a really great idea. Why don't you do an ROI on that and meet with me next week?" I said, "Al, no problem." And I walked out of the office, and I walked over to my phone, and I called my then mentor and said, "What's an ROI?" And he asked me why I wanted to know. And I said, I relayed the same story to him. And his response was, "He's just trying to get rid of you. Don't even bother." So that was not my perception at all. I thought that was very bad advice, right? And I just didn't buy that he was trying to get rid of me. I just didn't buy it. So I did what a lot of really persistent, painful people would do. I went to Barnes & Noble, and I bought 3 accounting books, and I put them on my next one. And what I did was, that night, I flipped to the ROI section and read all 3 books, the ROI chapters. And over the next 5 days, I put together an ROI for a new ambulance. I'm sure I did a terrible job. I have it somewhere. I haven't looked at it. I probably should open it again just for sheer, what giggles. And I got the ambulance. It actually helped our overall flow at that time. This is several years ago. But then the books sat on my shelf, and I eventually picked them up again. And as I started reading them out of curiosity, I started getting to the true spreadsheet section, the P&L section, and all the kind of different sheets. And I then went online and found the one for what was at that point North Shore LIJ, and started reading my actual company's spreadsheet based upon
because then I'd have to reload all the slides.
Based upon what I was learning in the book. And it was fascinating. I loved the fact that I knew exactly where they were making their money and where they were spending their money. And then I actually tried really hard and eventually got my hands on the individual breakdown of the individual facilities business. It took me about 6 months to be able to get it, even as essentially the acting chair. And I started looking at every facility, and especially mine. And then I started trying to get my hands on every individual department, including my own, because I loved the fact that I could actually figure out what was really going on. And it drove my personal kind of mission to learning this stuff. And it's helped me in so many ways.
Yeah.
It's helped me from the standpoint of, I feel I'm much better at looking at metrics for anything because I understand this concept. Now, there are lots of ways to hide money and to essentially lie with a spreadsheet, and we'll talk about some of those. I'll give you the most common ways that people create whatever they want to create. So we'll actually talk about that. I'm not sure what else I can talk about. All right. All right. I'm going to divide them. We're going to start talking about a couple different issues, and I'll actually slip through the slides. We're good?
Yep.
Excellent. Shall I?
I believe so. Working. Advance. it on?
By the way, just to let you know, the email that's sent doesn't have the PowerPoint. It's not in there. You know.
The email that you got did not have this PowerPoint? Okay, we'll make sure.
Not there.
It just has like core syllabus and the best you.
Is it out of batteries? No.
Teacher assignments are recommended reading, but not like.
Okay.
I'll stand if you stand there. We're good?
Yeah.
Okay. My goal at the end of this 45 minutes is that you have a basic understanding of what these things are. Okay? In the next session, you'll get some more in depth on several of these topics. But my real goal here is that you actually basically understand when somebody uses one of these phrases, what it actually means. And that's a really good starting point, you actually learning what these things are. So this is pretty much it. It's not much for one 45-minute session, right? All right? And the rise and fall of the Roman Empire? Okay. So, we love acronyms. So do business people. But these things essentially are just their shorthand way of saying things quickly, and I'm convinced, just like us, their longhand way of making sure they're the only ones that actually know what they're actually talking about. But things like COGS, which is cost of goods sold, P&L, profit and loss, return on investment, are essentially very, very basic concepts, right? What's a return on investment? A return on investment essentially is if I invest this much money over a period of time, how much of a percentage of that money am I going to get over a period of years? That's all it actually is. Pretty basic, right? Right. But when they actually present it in such a way, it's a confusing kind of concept. I'll go backwards. Perfect. So, first thing to know when you're looking at a financial statement is, what am I actually looking at? All right, and there's really only four basic kinds of financial statements. So the balance sheet. The balance sheet essentially is a sheet of paper that tells you what a company owes and what a company owns. That's all it is. One of the clues as to the fact that you are looking at a balance sheet, because I will tell you here, folks, one of the most important things is that you can look at a balance sheet and know which one of these four you're actually looking at. Okay? And there's some clues as to which one you're actually looking at, because some of them will be labeled different ways. So not every company will label their balance sheet as a balance sheet. Not every company will label their statement of operations as a profit and loss. There's different labels to it. And that's actually why it's important that you actually are able to recognize which one you're actually looking at. The easiest way is the balance sheet is as of a certain day. So, if you're looking at a document that has one date on top, you are probably looking at a balance sheet. Okay? The only caveat to this is if it has one day and it says as of, you might be looking at something that started within a certain period, so just be careful. Okay? But a balance sheet will essentially tell you everything that an organization owns or someone owns. Now, with smaller entities like departments, you typically don't have a balance sheet because as a director who's actually running a residency, what do you actually own? Not much. Right? So you will never look at departmental balance sheets. You will absolutely look at some of the other sheets in relation to individual departments. But it's important that you actually know what that is. Now, a statement of operations is always looking at a certain time period. Typical would be a quarter or a year, right? Occasionally will be for a 6-month period, but typically will be for a quarter or a year. A properly labeled statement of operations is actually supposed to give you a beginning date and an end date. They don't always do that. They will sometimes tell you quarter as of, year as of, which could be their way of saying it's a quarter or a year. But it must be for a period of time, because what you're actually seeing here is how something performed. It's a statement of its operation. Right? So, a statement of cash flows. A statement of cash flow is essentially looking at how liquid something actually is. Do you ever wonder how a bank could go under when they have some number of billions of dollars in assets on their sheets? That's kind of confusing concept, right? Well, it's not that confusing if you think about the fact that if there's $0 to pay their employees, they're going to close. Because no one's going to work now. So a statement of cash flow is looking at liquid capital in a particular moment in time. And a statement of change, sadly, can be any of the above with two columns comparing one period of time to a second period of time. So when you see a statement of change, I would ask you to actually go back and say, okay, what am I looking at? Am I looking at a balance sheet? Am I looking at a statement of operations? Or am I looking at a cash flow? Now, in getting more in depth in the balance sheet, what are your assets? What are your liabilities? Most common assets for a hospital are? What do you think? What are the biggest assets for a hospital? Property. Some of these facilities are built on property that's literally worth millions and millions and millions and millions of dollars, right? What did one of these places in Manhattan actually sold one half of a building for some insane $180 million amount, which you think about what that does to a bottom line, it gives you is pretty crazy, right? Except for the fact that once it's done, right? That's a problem. We'll talk about it a little bit in a second. So assets, equipment. Equipment degrades, but especially in the world of advanced radiological imaging, equipment is a relatively expensive asset, right? Liabilities we'll talk a lot about. What do you think is the biggest liability of a facility, specifically a hospital? Salary? Yes, salary is the biggest spending point, but the biggest liability is always money owed. Every hospital system in the free world at this point owes money up to their gills in different ways, and we'll talk about that a little bit in a second. Okay, important thing here with the balance sheet. When you first look at a balance sheet, it's going to look like every facility is worth nothing. Because at the bottom, all balance sheets equate back to zero. And that makes no sense, right? If they're worth nothing, that would be a real problem. They're not worth nothing. For some reason, and I still don't totally understand this, and I've had multiple accounts try to explain it to me, and I think it's BS essentially. They're taught that a balance sheet has to equal zero. So they have a line called retained earnings, sometimes called something other than retained earnings, but look for that line somewhere. That's actually what their assets over their liabilities actually are. So the retained earnings number is what they have minus what they actually owe. And that's actually an important number when you're actually looking at these things. So look for that line somewhere. Because if you look all the way to the bottom, which is what we'll kind of talk to in medical school, right? Look at the bottom. It'll say zero, and it'll be completely confusing. So, when you look at this company, classy company, right? You've got the assets up front. Cash will always be listed up there. People want to know how much cash you have in hand. It's a critical concept, especially for hospitals that are very payroll dependent, right? Lots of payroll. So everybody wants to know how much cash they actually have. Short-term investments, accounts receivable, we're going to spend a lot of time talking about. Does everyone here understand what the concept of accounts receivable actually means versus accounts payable? So how many people here work a shift the day before they do that? Okay. You already generated that money, right? Meaning you did the work that is tied to a bill that's going somewhere. But the money hasn't showed up yet. In a certain kind of account that we're going to talk about, that money has already been taken into account, You've done the work that has generated an amount of money that has been taken into account, but no money has actually showed up yet. So the fancy phrase for that is accounts receivable. You did the work, you haven't gotten paid yet. Okay? The flip side is an account payable, which is you received the thing, but you haven't paid for it yet. How long does the average hospital take to pay their bills? A really long time. Depending upon the hospital, anywhere from 45 days to 180 days is their average time until they will pay their vendor. Which is pretty crazy, but we'll talk about why they actually do that. It's actually a really good reason that they actually do that. Assets, property, land, and equipment. Okay? Goodwill, always look for intangible assets, wacky assets. What are they referring to as an asset? People will try to slip things in there that are actually kind of unusual. Liabilities, accounts payable, salaries payable. So for instance, it's December 31st, and there's 3 days into a new payroll, but your employees haven't been paid for those 3 days yet because payroll is 10 days later, right? That money has already been spent. It just has to be accounted for. Okay, it's essentially the same concept as accounts payable. Interest payable, same concept. Long-term liabilities. We're going to see actual individual reports from the health system. This is where the big money is. This is where the big dollars are actually going to be. So, stockholder equity. is another phrase for retained earnings. Stockholder equity means that's what's actually left over. That's what the company's actually worth. It's A minus B. Okay. The first thing I do when I look at any financial statement is look for my double lines. Okay? They're there for a reason. A properly set up accounting sheet will have double lines between sections so that you don't confuse yourself, except for the fact they never tell us that, right? So always look at where your double lines are when you're actually going through it. What did I actually generate? Your gross profit is always referring to your revenue generated. So, anyone ever watch CNBC? Ever? Have you ever heard they beat in the top line, but didn't beat on the bottom line? Beat on the top line is essentially fancy phrasing for they made more gross money than they were expected to make. They thought they were going to sell 200 widgets, they sold 240 widgets. Or they raised their price per widget mid-year and made more money than they were expected to make. So a top line beat, okay, means that you generated more revenue. Now, most of the time you generate more revenue, what happens? You spend more money, right? So a typical example for an ED group would be, all of a sudden the hospital down the street closed after X number of hours of freestanding ED, you saw those patients, but halfway through you realize, wait, I have to schedule another 6-hour shift to make up the difference. You made a lot more money on the top line, but you may have actually lost money on the bottom line. We'll talk about that in a second. Because you all of a sudden had to pay for a certain asset, right? What did I spend? Be careful here. I'm going to give you one example of how expenses are divided. Everyone divides their expenses differently. This is going to be the first example of, I highly recommend that all of you go and pull up. Does everyone here work for either a not-for-profit or a publicly traded company? Is there any private but for-profit company out there? Good. One. All right. So other than PO, every other one of you has the ability to actually go and get the actual P&Ls and all financial statements for all the companies you're actually at. The only way to get comfortable with these and the ways they split them up is to actually look at multiple ones. Okay, we'll talk about a couple of the most common examples as we go through. Like you said, in healthcare, people is where it's at. You are spending the biggest percentage of your money on people. It's not even close. In terms of actual revenue generated, the biggest dollar is on people. So, Larry's landscaping. All right? This P&L shows you that it's all part of the same calculation because there's no double line until the bottom. There you go, until the bottom. All right? Larry's income is in these 4 buckets. He gives you a total income. Now, cost of goods sold. You may never see this ever again on a healthcare finance sheet because the cost of goods sold are pass-through costs. And they're so limited in healthcare that sometimes hospitals don't even report that way. So, a cost of goods sold for Larry is, what do you think? He buys the fertilizer, he puts it on his truck, he moves it over, he bills you for the fertilizer, he spreads the fertilizer on your lawn. Okay? That is Larry's cost. His cost of goods sold is his fertilizer. Okay? In healthcare, what's truly only a pass-through cost? Tylenol? The only real expensive one is maybe a piece of medical equipment you're putting in somebody. But most of it is not true COG because we're doing something unique to the COG. We're using a person and doing something. Most of the things that we actually do involve unique personnel. Right? So it's not truly a COG for most of the things that we actually do. Okay? So Larry's gross profit here is $61,478. Okay? Now, Larry had to pay himself and his other workers, right? So even for Larry, again, another actually relatively labor-intensive business. And now he's got them all listed down, his total expenses here. Now his net ordinary income, okay? Look very carefully at these for your financial institution. If you don't understand one of your buckets, you have to ask somebody. Because the buckets are supposed to be very, very clear when you're actually looking at these things. And I'm not going to begin to tell you that I can explain all the buckets to you because it's once you've looked at one company's profit and loss statement, you've looked at one company's profit and loss statement. So you have to feel comfortable with your individual company as you're actually going through it. You should be able to ask. Okay. Net ordinary income. Now we start talking about net and net. All right? Net will be listed here. Net will be listed here. These things down here can be positives or negatives. So, what do you think for hospitals is the most common change between net and net? Think about it. No, it's not. It's actually what they owe and actually have to pay off. So if they've issued bonds to go out to somebody to generate revenue to build a new building, right? They get those bonds depending upon their creditworthiness, and we'll talk about that in a second, at a certain interest rate. They have to pay that interest back. They have to pay that money back. And the interest and the money they're actually paying back comes off their net ordinary income, right? Because at the end of the day, if they have to pay $20 million a year back, but they're only making $18 million a year back, they've got a problem, even though they could be actually generating money on the top line. Okay? So debt load becomes a really, really big deal. Any questions up until this point? Please.
Yeah, so if I'm understanding this as gross income, he has buckets of expenses, and at the end of that, which include paying himself, then there's some money left over.
Correct.
Which you can call profit to the business. If he was just owner, it would just be profit to him. It could be that. It could be. But at this point, it's profit to the business, let's say $500,000 for the year. And then you're saying minus whatever loans you think that.
Right, what if all of his lawnmowers still have a note on them, right? Still have a debt note on them. What if there's different ways that he's actually got, what if he, for instance, prepaid or has to pay somebody else to mow their lawn next year? Businesses have wacky arrangements, right? If there's something that doesn't figure into your regular income, that has to come off of between the net and the net. But not all, the biggest difference in those two numbers is always debt load. It's always how much debt you actually have. It's always the biggest number. And that's probably true, to be honest with you, of almost any business, and not just health.
Why wouldn't that be in the regular expense section?
Right. They don't put it in the regular expense section because the way these sheets are put together, they want to gauge you first on how much money you make in your regular business. So they actually, you're doing this for the people that are going to loan you money. The reason for these statements are actually not for the people that work for you. They don't actually prefer not to do this. The reason for these statements are mostly this. Is that better?
Yes, thank you.
It's kind of a small room, actually. But
Yeah, we recorded, so.
well, there you go.
Does that mean we can listen to this again?
Well, not the first part because it was not.
That's funny. If anyone really wants a recording, I don't know why you'd want to, but if you really want a recording, we're actually developing an administrative curriculum at our home site that we're actually going to put up for free for anybody who wants it. So I should eventually, this will be recorded at some point, and I should be able to share it with you guys. One of my fellows' brilliant ideas I thought was actually pretty clever, so we're slowly going to be sharing that. It'll eventually get on the website, and once it's actually recorded, I'll be happy to share it with whoever wants it. All right. Like I said, divisions are internal. You have to decide how we're going to share it up. I had a couple questions. Did I answer your question? Sort of. I got caught up in the middle. What was I saying?
We just asked why the debt and the expense section.
Thank you. They want to gauge you twice. They want to gauge how well you're doing on your actual core business, right? Which is really a gauge of how well you do to day-to-day operations. And then they want to gauge you overall after your debt has been paid and all the extraneous expenses have been actually paid. So there's actually value to knowing, so for instance, if you were going bankrupt, they only really care about everything up to here, right? Because everything on the bottom line, once you're going bankrupt, if they're going to buy your business, the only thing they care about is can they make money going forward, right? Because they're not going to owe the money. You've already lost the money, right? So they're going to try to buy your assets and actually close you out. If, for instance, Larry's landscaping all of a sudden takes too much debt and now he's losing money, and Larry goes to Frida and says, hey, Frida, I'll sell you the business. She can buy the whole thing, buy the whole route, buy everything. She's not going to actually get Larry's debt. So she actually has to look at it a slightly different way. That's actually why it's listed out separately. Okay. All right. We did this already. Now, this isn't technically in a spreadsheet, but not knowing this, I think, is actually, it kind of limits you. So we have to go into a couple of topics. One of my biggest problems in putting this together and why I stripped a lot of these things out is, as you start going into spreadsheets, there's a lot of really important topics that if you don't understand, you actually can't even learn this. Okay? So one of the first ones that comes up is the concept of fixed, variable, and incremental expense. Okay? What is a fixed expense? Right. So if you own a hospital, what's a fixed expense? Electricity. Last I checked, if, they're not turning off the power anywhere when they're not using anything. It's always on, right? What are other fixed expenses? Are people a fixed expense? In most places, they're almost completely a fixed expense. Last I checked, how many of you staffed down based upon what the volume was that day? Very few. Most people staff exactly the same every single day of the week. What does that actually mean? It means your people have become a fixed expense.
But hospitals close the wings when their census is down.
They turn that wing into a variable expense. That's correct. That's exactly why they do it. They turned a fixed expense into a variable expense. And that's a huge thing. It means that chunk of is actually saved when the lights are off on that particular day. So you're exactly right. I was going to give you that example. Yes. When you are closing down a wing, you absolutely are taking a fixed expense and turning it into a variable expense. As long as you are actually letting people not work that day. Right?
They cut nursing hours and send nurses home from the ED all the time in our department when COVID was up.
So financially, you have to ask yourself this question. Are they telling people you can't work and not paying them? Then they've turned that person into a variable expense. If they're saying, hey, you can use your holiday time, it's still a fixed expense because they're taking a different way of paying them. So some of you work in parts of the country that can do that. So I work in New York where that's just essentially impossible. You just can't do it. It's just physically impossible. We're too unionized. It would just be impossible to do that. But there are parts of the country where they do that, where this is less true. But at the end of the day, whatever percentage of nursing staff, physician staff, PA staff, whatever else you have in that institution will always be there on a day. That's fixed. That money is being spent no matter what you actually spend. Okay? So in healthcare, even in the places that close down wings, the biggest part of your expenses are actually fixed expenses. Okay? What's your biggest variable expense? Well, let's actually finish fixed expenses. Okay. Machines, right? They're already there. Right? You're not going to actually bring them in, bring them out. Variable. The biggest one is that. A TAVR's $30,000. So that's a real variable expense. Because that patient, if you're putting that valve in, they're spending $30,000. And if you don't, they're not. That is a true variable expense. It's one of the only examples of a true cost of goods sold, right, in the healthcare world. Okay? Interestingly enough, incremental expenses in healthcare are rising because now we're at the point where something as simple as a pacemaker can cost as much as $5,000 to a facility, and that's at a reduced cost. So variable expenses are becoming a bigger deal as these things become more and more expensive. Now, getting hospital administrators to understand their own finances sometimes can be tricky, and here's what I want you to learn. How often have you heard, this is a bad admission about a COPDer? You hear it all the time, right? Unless your hospital is literally canceling the OR or is actually physically unable to process the next surgical patient because you're that full, and last I checked, they'll fill the ED before they ever cancel the OR, right? That is a complete misnomer, and it means the person who's saying this doesn't truly understand how it actually works. Okay? Now, I wouldn't recommend you would say that to that person. But I would recommend that you gently try to educate them on the concept of incremental cost. So, the hospital's full. There's one bed left. And you just had a bad admission, a COPDer who you tried on CPAP, BiPAP, didn't improve. You went through the whole process. They're just too sick. They're just too sick for OBS, which of course now is almost nobody, but let's make believe, right? What is the cost actually of that patient? Nothing.
What's the incremental cost? You're not bringing in a nurse. What's the incremental cost? Linen? The incremental cost is linen, and that's almost it. What? Sorry? The opportunity cost is, would a surgical patient have come in and filled that bed that day? Right? And I would argue, not really, because what happens is if a surgical patient comes in that night, all it means is your next ED patient is going to wait in the hallway as the next bed becomes available. So I would argue that unless you are truly at a high functioning place that rolls these people in and out, most institutions have really not figured this out right. Some CFOs have figured this out now and are absolutely figuring out ways to fill around the edges, right? And the reality is there's almost no such thing as a bad admission for most facilities. Financially, there are for certain situations. But for most facilities, the only way that's not true is if you're in a place that's aggressive enough to shut down a whole floor. If they're trying to shut down a whole floor and eliminate 50 bed admissions a month, then it would be horrible for healthcare, but might be good financially. And people have done that, right? There's been multiple examples of this in the literature over the last 5 or 6 years of places that have done this. But in a regular place that's not looking to shut down a whole wing, that next patient is never a bad admission. Unless it's such a bad admission that it just won't document and it's just going to be an automatic denial and yada, yada, yada. But a plain old average admission that you've actually documented well, there's really no such thing. Okay. Next concept. Now that we've explained the concept of the 3 different kinds of costs, and I've explained to you they have these 3 different sheets, before we actually look at a sheet, you have to understand that there's 2 different ways of creating a sheet and 2 different whole methods of accounting. Anyone understand the difference? Anyone has ever heard of the difference between accrual accounting and cash accounting? Okay. So, the best way to actually talk about this is to create a hypothetical situation. So, you saw the patient on 12/30. Your bill was paid on 1/15. That's actually, to be honest, for emergency medicine, a pretty quick turnaround time. Right? Your financial statement that you're about to produce, tell me again, which financial statement is this? Which financial statement am I producing? A profit and loss, likely, right? A statement of operations. And how do you know that? For 2 reasons. It's a timeline, right? And you're actually using cash generated. So you know it has to be a P&L, right? That's good. All right. Well, how do you account for this money? So there's 2 different ways to account for this money. There's the way Larry probably did it, which is the way that small companies do it, which is cash accounting. If you got paid that year, it happened in that year. If you got paid in the next year, it happened in the next year. Okay? So in this case, going back, Larry presents this information and it'll actually be in next year's P&L. So in his situation, it'll be in 2016. The good thing about cash accounting is that it matches what's in your checkbook. You don't get caught in weird situations where you look on paper like you're doing great, but you don't have any money in the bank to pay your people. With cash accounting, if you're positive, there'll be cash in the bank. If you're negative, there won't be. It's the beauty of cash accounting. One of the biggest issues with cash accounting is that it really doesn't always reflect the work that you actually did. So, for instance, if you work in a freestanding ED that just opened in January, right? Opened in July, and is closing, and actually your books are closing as of December. If you use cash accounting, it's going to look like you did a lot worse than you actually did because you're probably increasing your volume incrementally as you actually go. So if you're only being credited for stuff you did 2 months ago, by the time you get to December, you're going to look like you did terrible. But meanwhile, you may have done a lot more work than you actually are getting credit for. Does that make sense to everybody? When you are in a steady state business, there's a lot of reasons you should do cash accounting versus accrual accounting, but it makes much less of a difference. When you are in a declining business or an increasing business, cash accounting can be truly problematic. It's important to note that there's almost no large business that still uses cash accounting. There's a lot of reasons that big businesses stray from it. But when you're doing your own books in your own head at home, you're probably using cash accounting. Okay. In accrual accounting, you treated the person in 2015, so it's in 2015's profit and loss. It stays in the proper place. But the money isn't there. So that gets put into your accounts receivable. I did the work, I haven't gotten paid for it, my accounts receivable grows. Now, what's one of the biggest problems in emergency medicine and accounts receivable, and actually specifically physician groups? What do you think is the difference between your accounts receivable and the amount of actual money you get paid? I would be very surprised if there were a lot of groups where it was anywhere approaching 50%. There are some, right? But there's not a lot, right? So, how do you account for that? Your accounts receivable, but let's say, what do you think the difference is between those two numbers? Who takes the longest to pay historically? What do you think? Self-pay. Also known as no pay, right? Medicaid takes long. In almost every state in the union, I've yet to find someone where Medicaid is actually paying faster than most of the privates. I haven't found it. I've asked people from numerous states. I've asked Mike Gronowski, who bills in like 16 states, and I can't really find it. Okay? What do those two things have in common? Crappy payers, right? So it means you actually have to know if my accounts receivable is, so my accounts receivable right now, as we're sitting here talking, is $11 million. Okay, that's my personal accounts receivable for just the two departments that I'm personally responsible for in real time. Okay? You have to know what percentage of that money I can expect to collect. So there's a number in there they actually put in called a historical collection rate. So every year, we actually figure out, all right, over the last year, how much came in out of the accounts receivable, how much went into the accounts receivable, what percentage did I actually collect? And every year we recalculate all of our numbers based upon what our historical collection rate is. Because otherwise, if you don't do that, you will absolutely misunderstand and misinterpret how much money is coming to you. So when you see a medical group with a $25 million accounts receivable, they're not going to get $25 million out of that money. Okay? Accounts payable. I'm going to ask you the question again. Why do hospitals take a long time to pay their bills? Delaying it makes more money coming first, which makes it look like they have more money than they actually have. Right? And if the company will let you do it, they will let you do it. Companies will typically wait a very long time for hospitals to pay. There was a hospital on Staten Island about 6 years ago where they actually were out with the drug companies that serviced them by 9 months. And they had received nothing and were still supplying drug. And they finally got paid when they stopped sending drug. Right? So those kinds of things do actually happen. Now, important concept with accrual accounting. Accrual accounting creates much more flexibility. Now, would anyone here argue that the terms accounting and flexibility probably shouldn't be in the same sentence even? And yet they truly are. So now, I will give you a positive accountability, a positive way of being flexible, and a negative way of being flexible. So I work for Northwell Health. Northwell Health a few years ago, and I still think it was the right decision, but thank God it wasn't my decision, started an insurance company. And then one of the caveats in Obamacare was they were going to create this pool of money, and then they were going to decide that if your health insurance treated less sick people, you were going to pay money to the insurance companies that paid more, that actually treated more sick people, which at its surface sounds like a great idea. Except for one basic problem. After about a year of this in New York State, what they found was all the insurance companies that have been doing this a long time that have really good records, guess what happened? Their people all of a sudden got sicker. And all the new insurance companies that were trying to create competition for these big mega insurance companies couldn't hack it. And they were paying them millions of dollars flowing. So in 2017, Northwell, in their new insurance company, was set to lose $120 million. So guess what they did? Peace out. But what they did was, and here's creative accounting, right? What they did was they figured out how much they were going to lose in 2017, and how much they were going to lose in 2018, because it turns out you can't just cancel insurance. You have to let some time pass that, people are still insured, contracts are still out, and yada, 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 and took the loss all this year because they wanted clean books for 2018 so they could be judged based upon their actual performance. I personally think, well, why would they do that from a financial standpoint? I want you to think about this. They cleared their books of this horrible thing, which would be perceived by finance people as a horrible decision, for two reasons. Number one, they can be judged going forward based upon what they actually did. And number two, they never have to talk about it again. So they took the loss early. Now, I personally perceive that as a positive way of creative accounting. Now, a negative way of taking creative accounting. Does everyone remember all this controversy with the banks a few years ago with subprime mortgages? So, let's say I'm a bank and every person in here was given a bad mortgage. Every single person in here. Right? What they were actually doing was they were assuming in their books that every single person in this room would make every single payment and claiming that was their real money. And then as some time would go on and they needed to actually get rid of some money and actually could justify taking small bits off, they were finally claiming it on their P&L, so their P&Ls looked better than they actually were. That is a truly sneaky way of using creative accounting in a P&L, and every single bank did it. Some of them still do, actually. Okay? They were forced for a while to actually put the real value of those mortgages in their P&Ls, and that lasted for about a year, and now they're back to putting in whatever they want. All right? So, the point here is, when you see one-offs in an accrual accounting sheet in your balance sheet, you should be able to explain what that actually is. What do I mean by a one-off? One-offs are the things in the bottom. Weird things that happened one time. Right? Now, some of those things are real. Right? I had a one-time cost for my residency because somebody was delayed in their residency, so I had to send 10 people to ASAP this year, not 9. It's a one-time additional cost that's going to be reported somewhere. That's okay. But the one-offs of a very large number, you have to be very careful with and figure out what they actually mean. It's the other reason why the difference between net and net becomes extremely important. Any questions here before we move further? Okay. My favorite accounting lie is depreciation. All right. So if I buy a CAT scan machine, I'm allowed to depreciate about 20% of my CAT scan machine for 5 years. Last I checked, how many of you have seen a CAT scan machine that was only used for 5 years? There's no way, no health system on earth today is throwing away a CAT scan machine after 5 years. But they're essentially holding on to something that essentially now has no value. But they're still reporting it in their balance sheet, but it has no value in their P&L. It cracks me up in terms of how this is done, but they actually get a credit. And they actually get a credit in their taxes. I'm sorry, not in the taxes, but a private company would get credit in the taxes for the depreciation cost. So I personally love depreciation. I think it's actually one of the biggest bits of BS that has ever existed in terms of how we report these things, but it's actually true. Depreciation is extremely variable. So again, depreciation costs, I would actually say if you're looking at a large company, but it's more if you're looking to invest in place. If you're ever in a situation where you actually are crazy enough to try to buy individual stocks, you have to learn a lot about depreciation because you can get some really crazy situations. Yeah. Yeah? 5 minutes? Excellent. Perfect. Debt. Debt means everything. Bond affect everything that we do, and the cost of borrowing money is huge. So, this is the difference between the net and the net, and we're coming to the end here. Healthcare is a very high cost, very low margin environment. Does everyone understand the concept of margin? What's margin? I collected $1. How many cents did I get back in profit? So if you're Google, what's your margin? They just reported. Anyone know? 38%. It's pretty good. If you're the most successful healthcare company that is not private in America, what is it? The most successful, one company is like 12 almost every other year. The average is 2. The average in New York State is 0.25. To give you an idea. Okay? But what does this actually mean? if you're going to build that new wing to take care of women's and children's, right? And you need $50 million and you need to borrow it. Your rating is going to be based upon how you do certain things. If you are charged 3% for your money, it's $58 million for that $50 million. If you're charged 4%, it's 61. If you're charged 5%, it's 64. It's a $3 million hit for every point you pay up. So if you're only making a couple of percent on your margin and you all of a sudden get your bond rating goes down and you go from actually having to pay $58 million to $61 million over a period of 10 years, that's a real problem. It's a real problem. So bond rating becomes an incredibly, incredibly important thing. And I want to talk about what goes into your bond rating. There's the fluffy stuff and the non-fluffy stuff. So, and here's what we're actually talking about. So the fluffy stuff. Oh, this is the non-fluffy. So what do you think is in the fluffy stuff? I want you to, there's a lot of fluffy things that go into your bond rating. It's hilarious. Vision. So, can anyone name a company that has never made a single dollar, that every single one of their products they've ever made has lost money, and yet they have a great bond rating because of the fluffy stuff? It's classic. For about 6 months, it was worth more than General Motors. It's Tesla. Tesla has lost money on every single thing they've ever produced. And yet, they're able to borrow money at about 2.75% because people love Elon Musk. So fluffiness is related around the leadership, how much they buy into the leadership of the individuals. But then there's the non-fluffy stuff. And when you look at the non-fluffy stuff, and you can actually pull this up of Fitch, it's all days cash at hand. How many days can they cover payroll, right? Cash to debt ratio, operating margin, personal costs. It's all these all these cash-driven things that are actually there. This is why hospitals pay so late, because they can hold it into their account for a few more days, and it actually helps their cash in hand. The problem is only a one-time help, right? Every time you delay by an additional day, you get a one-time benefit, which then never goes away. But what it does mean is once you've taken that one-day hit, a one-day benefit, you can't go the other way. If you go the other way, what happens? You take a one-day hit. So it actually becomes a self-fulfilling prophecy. And essentially days cash at hand is in a resource-intense, low-margin environment, how many days from closing actually are you? All right. I guess I'm going to have to stop now. I apologize. It took a little longer than I thought. You will get this thing, and there's actually a real-life example of a current company. It's actually Session Health, which is actually one of the largest. And I just put it up there, and you can go through, and you should be able to go through this. Essentially, assets, balance sheet, assets are ending here, right? Liabilities, going through, darker line, they're ending there. You subtract one from the other. P&L, okay? And I'm happy via email to answer any questions you guys have on this, okay, as we actually go through it. And that's their cash flows, and that's the repeat thing. And I think most of you could actually at least give me a rough understanding of what these basic things are. Hopefully. Maybe. Kinda. Any questions? All right. Is anyone's head going to explode yet? I don't want to do the wrong thing.
Could you put this in your mouth or we go? I just put it on.
Test.
Works.